KPMG Distinguished Professor of Accounting and Information Systems at Rutgers. He's also the director of the Rutgers Accounting Research Center and the Continuous Auditing and Reporting Laboratory. We also have with us Nancy Baumgartner, who is an audit partner at KPMG and currently works in the U.S. Office of Department of Professional Practice at KPMG. And Nancy also has experience in innovating audit methodology and improving efficiency and effectiveness. We also have with us Greg Shields, who's a retired director of the Auditing and Assurance Standards Board at CPA Canada, and is also involved in the 1999 joint study by CICA and AICPA project on continuous auditing. And Miklos and Nancy are also contributors to the new book on continuous auditing and data analytics, which I read with great interest, so looking forward to today's discussion. Today's discussion will start with Miklos and Nancy discussing some new developments in continuous auditing, and then Greg will have a discussion on his insights as a standard setter on the new insights in continuous auditing, and we'll also hopefully have time for Q&A.
Thank you. Thank you. I actually found something very interesting. We thought that original work on continuous auditing was done in the late 80s. But we found the mention of continuous auditing in Montgomery Auditing, second edition, published in 1919. And I just want to read you what Montgomery Auditing, Montgomery was the Coopers & Lybrand, the original predecessor firm. And continuous audit. This term applies to the supervision by an auditor who attends at intervals during a period and makes a report of the progress rather than a report that embodies a balance sheet and a profit and loss account. So the concept of intermediate evaluation was introduced by Montgomery Audit. And then they say in modern practice is 1919, this distinction reserves little consideration. Up-to-date concerns demand monthly reports of operations, and monthly balance sheets follow as a matter of course. So without computers, he said things need to be more frequent, and this was 1919. So today is a great pleasure to be here. We did the Red Book in 1999, and I worked with Greg for a long time. And we continued in contact. Greg comes to our conferences. We continue talking. So it's kind of a real delight to be here. And after 1999, when the Red Book was published, in 2003, IIA published GTAG number 3, which was some guidance continuous auditing. In 2010, ISACA came in with their 2 guidances. And just a couple of months ago, not even a couple of months ago, we issued what we used to call the Pink Book, now the Red Book. And this is audit analytics and continuous auditing. And actually, like everything, project that you start and you finish, it doesn't come out what you planned originally as a different animal. And actually, it is a little bit different, and I kind of like it better than what we planned. So this is actually the outline of the book. The book was produced by the AICPA and is available for purchase. The AICPA also is available in electronic form. And basically, this first chapter that we're going to talk today covered kind of a rethinking a little bit of what continuous auditing would be. And then the second chapter basically talked about what's happening in the accounting, in the auditing industry. And basically, the conclusion was none of the big 4 are really doing continuous auditing in the clientele, but 2 of them are doing consulting to internal audit organizations on continuous auditing. And then a couple of the other chapters, we talked about evolving audit towards a more modern audit, like what we call the continuous auditing. And then one chapter, Trevor Stewart wrote it, was dedicated at audit analytics. And just as we are now thinking about the Green Book, and the Green Book will be guidance and will be associated with guidance issued by the AICPA in audit analytics. And then there was a chapter talking about this idea of continuous risk monitoring. And finally, we had 4 cases on the book. And the book's probably worthwhile giving it a look, and it can give you a lot of ideas for research or for practice improvement. Okay, and this is the definition that we had on the Red Book of Continuous Audit. Continuous audit is a methodology that enables independent auditors to provide written get to my clock here, a written assurance of a subject matter for which an entity's management is responsible, using a series of auditors' reports issued virtually simultaneous with a short period after occurrence of events underlying the subject matter. So that was the definition, and in this chapter we kind of looked a little bit about how things have evolved with technology and how things should be different with the experiences we have. Now, the basic axiom behind this continuous auditing idea is that you have a model, you have an actual, you compare the two, and if the variance between the two is large enough, you issue an alert. Very simple, very basic type of thing. In our original, we are now in the 35th World Continuous Auditing Symposium, will be in November. In the first few symposia, we spent all the time arguing what is a continuous auditing, and in the most recent symposia, we spent a lot of time arguing about what's the difference between continuous auditing and continuous monitoring. This is actually out of a white paper by KPMG that basically says continuous auditing is what auditors do, continuous monitoring is what management does, and that's the best difference to establish. But I always tell my students that you basically need a layer of continuous monitoring in order to do some continuous assurance. However, if the company is not doing that for you, auditing has to develop this layer. Then over the years, or in the last 20 years, we have been developing this whole idea of continuous auditing, and we started with the circle in the left, and at that time we called that continuous auditing. In 2003, we developed this project with Siemens, and we come up with this conceptualization that we could look at the settings of an ERP and compare it to a baseline. And if there had been user adjustments of that value, you would have an exception. And recently, may last 3-4 years, a couple of my PhD students have been working in this idea of risk monitoring and linking risk monitoring to continuous audit. So now we kind of basically think continuous auditing at 3 components. One, we now change the name to continuous data audit, then control monitoring, and then risk monitoring. We have this idea, and that we have that in yellow, that maybe it would be a good idea to use the same tools that we use for the audit monitoring for compliance monitoring, but we haven't done any projects in this slide. I'm going to let Nancy explain you a little bit how this can be interpreted and thought of.
So as we were working through this, we reflected on the fact that up till now people have primarily thought about continuous auditing as an internal audit type of tool and mechanism. And as we were broadening our view of this, we realized there's actually a lot of different people that could benefit from continuous auditing. And so we started penciling out who might be the users, for what purpose, and that's down the left side. And then across the top, we were thinking about different elements. So in what ways might continuous auditing be used? And every time that Miklos and I open this up, we feel like we could make changes to this. So what you're seeing here is what's memorialized in the book, but I would say my views continue to evolve on this. So if you see something up there that you question, I would accept that. So if you look down on the, oops, look at that. How do I get it back? There we go. So if we look at who might use it, management clearly is a group of users. I have audit listed, both internal and external audit. Internal audit, I think, is pretty self-explanatory. From an external audit perspective, external auditors look at what the company does for their control environment, what they do for monitoring procedures. And so all of these things in continuous auditing actually can be used by external auditors as they're getting familiar with the company, looking at things like inherent risk and control risk. So it certainly can be used by external auditors. Investors will benefit from having more assurance over things like data, and regulators as well from a compliance monitoring, risk monitoring perspective, especially in the financial services industries. You could see from a regulator or a compliance perspective where some of these tools might be very helpful. And it's not just backwards looking, it's real time. Also diagnostically, if you found an error, you could run some diagnostic tools to see, pull together information, which then you could analyze and figure out a way forward. The bottom, we added a couple of lines about automation or manual. So much of what continuous auditing, it's all about automation and having technology and tools to deal with that. But as people have spoken all day, you can't completely take judgment out of data. So in order for it to be, we need to have some judgment involved. And I'll say that's going to be true until artificial intelligence progresses to a point, or cognitive tools develop a little bit more of them where they are today. But if we're going to be looking at a management or an audit by exception basis, certainly the manual intervention will continue to be important. So with that, I'll hand it back to.
Thank you. And so this slide talks about kind of the stream of research that we have been doing for the last 20-something years. And the first paper was Vassarelli and Halper. And since then, we have been kind of slowly expanding the concept and adding analytic methods, for example, continuity equations, visualization, et cetera, et cetera. And what we have is really a potpourri of projects trying to do different type of things. And in the process, we learned a bit more about continuous auditing. And in the last maybe 3-4 years, I have started finding industry kind of partial implementations of one particularly highly sensitive, risky project being monitored and having some kind of online assurance. And in the right here, you see some of the examples of the papers that have dealt with it. Now, this was a chart out of the original paper, and we added 3 columns, and just for the most notable things is what are the kind of new technologies that will change a little bit the conceptualization. Big data, it's not, I really don't like to call it big data, but I like to say more data, and more data, and there'll be always more data. And then this idea of distributed processing, and finally, systems that are semi-intelligent and progressive intelligence. I just want to chime in with what Nancy said here. And within the imaginable future, we are not going to have auditing without auditors. And we have seen that certain things like bookkeeping became rather automated. And we expect the things that are very repetitive, the auditors do, or the kind of decisions they make that are consistent with certain cues could become automated. But in this whole domain of things, you automate certain things, other things arise. For example, this whole idea of using analytics in your audit, there is this component of interpretation of the analytics. And we are not very well prepared for that, as it was well discussed here. And we have actually a project, we call it the Super App application, where we have an audit analytics, and then we, copying a couple of pieces of research, we put some of the statistical decision-making involved in it into the tool. Eventually, there is some outcome that resolves some of the problems of the auditor in statistics, but still there is some judgment to be made there. And we don't think that there'll be really too totally ready super apps that the auditor don't need even to look at that. And most of the literature in implementation operation research says that if the user doesn't understand what is being done there, he's not very comfortable with that, particularly in kind of higher echelon decision processes. And so actually I have two sets of slides, and we don't have a lot of time, so I'm going to move two slides that talk about environmental changes and that kind of permeate and influence what we do. And first, data is always growing. And the question is not how big the data is what data do you want to collect for supporting your decisions. And the next question of that is actually even a more interesting question, a research question, is how do you use evidential method that's not the kind of traditional evidential method and that's not sitting on the standards. And we have, with different committees of the ICPA, have been always meeting with the Auditing Standards Board, and basically they say there is nothing really in the standards that precludes the usage of analytics. And that's true, but the question is not being precluded doesn't mean auditors will use it. There is an economic barrier. You have to do a whole series of things that provide little evidence, like sampling with very large data sets. Pulling a sample of 70 out of 60 million doesn't give a lot of evidence there. And that kind of consumes money, and if you consume the money, you're not going to do a lot of extra things because that's your profit that's left there. So it's an economic barrier. The other thing that exists is that there is all these new sources of data that are coming in. For example, data out of RFID hasn't really been used extensively in auditing. And RFID with an intelligent chip that attaches environmental information to the RFID also hasn't been used. And data with GPS hasn't been used. And as shown yesterday, so interestingly, in the R demonstration, you can basically extract sentiment information out of a Twitter stream about the company, and that's kind of interesting information, and can improve a lot your predictions about the company. And so there has been not really guidance on that thing. So this whole idea of new sets of data coming in and helping us in the audit, an interesting question to be asked is, can you audit a company without ever going to the company, just by using exogenous data? And you say, well, that's kind of nuts. It's not necessarily nuts. It's actually interesting thought. Certainly provide supplementary information. It certainly, maybe if you need types of audits that are not very tight audits within the gas type of standards, maybe it's good. If you're buying a company, you just want to find a few things about the company, or if there is any problems with the product, and et cetera, you can examine social media streams and get a lot of information out of it. So that's one thing. And so data will be really directed to certain decisions, and some of that data will be what we call big data today. And the other part is kind of the cost story. And the cost story is that the costs are incremental. And it's not like manufacturing something. When you develop software, once you have the software developed, the incremental cost of its usage is very marginal. And so that creates a whole set of different behavior that will affect auditing seriously. This is actually a chart, I'm not going to talk too much about this, that actually describes that AT&T continuous monitoring and the continuous auditing system that were developed with the same backbone, so basic supporting software, but different algorithms, different measurements that we are using by management and by auditors. And since that, we discovered that a lot of the analytics that we have developed in different projects actually are very interesting to management, and when they see it, they start asking a very different set of questions that auditors would do. Okay, I'm not going to go through these. They are basically elaborating on those four basic items. I just wanted to call a link to our other discussion here, the audit data standard discussion. And we have worked with the AICP on the audit data standard, and we are big advocates of the audit data standard. You heard a panel this morning about it. And the reason for that is that, again, the cost of cycles is very low. If you are set up nicely to pick up data, picking up the data once a year or once a quarter or once a month, maybe you want to pick up the data every day, every hour, make it as continuous as you can. So we think that the more we formalize the data and more whole family of apps is developing. Bob didn't really say that, but there is a lot of apps rapidly coming out. And we need to kind of just organize ourselves that either we have a common standard or we have standards that are transportable from one to the other. But we are very, very positive on the idea of an audit data standard because we allow, to pre-package audit tests in large quantities. We have a student, Junday, doing a dissertation that is using a recommender model to suggest apps to be used in a particular part of an audit program. And I think a lot of these types of innovative usages will bring into auditing a degree of automation that doesn't exist today. And we always talk about how educated the auditor is in statistics and computer science. And absolutely this is an important thing. But to our help, there'll be apps that will come in and they'll have good markets because they will supplement these weaknesses in the audit. And the next thing is we really talk about many, many dimensions of this audit automation effort that affect continuous auditing. And we have put in there 7 of them, but we actually could have come up with others. And then the second thing is, one more thing here, is the emphasis of the audit. The audit becoming, the discussion of predictive applications became big in media, became big in business. And the idea of an audit not being retroactive, but you projecting numbers for the future, and if those numbers match or are reasonably close to what management offers to you as the numbers, then you don't do a lot of work. It's a very interesting idea. And what we need to do is improve our predictive analytic methods in a way that you can trust them. We have a couple of projects in that direction, and the results are astoundingly interesting. And I'm going to conclude. I know that I'm kind of running out of my time here. Talk for a second about audit automation. And we actually have been thinking about this, and we are just starting something that we want to put a prototype together of auditing in an automated environment. Again, all of these pieces of the audit will have a human element. But the overlays, where it comes to a point of making a decision that is not totally deterministic. And so we kind of imagine this as, if you see in the middle, a whole set of little applications running all the time. Applications like detecting split transactions. Applications, is this transaction entered at lunchtime when no transaction should be entered? And there are hundreds of these that you can develop in idea, with certain idea. Some of them are much more dangerous than the others. And so you create some kind of suspicion score, and you see wherever the thing, look at transaction that was pinged by 3 or 4 of these things. And basically what the system would do, companies would have the ERPs and other related systems, and when data comes in, that's the yellow arrows, they would kind of flag little agents sitting over there, either time-oriented agents or event-oriented agents, that would start some of these tests. And before you send the transaction out, you would run again through a whole set of related and relevant apps. And if he gives a high suspicion call, you wouldn't let the transaction go out. You'd pass it to a human or to a diagnostic system to pick it up. So this will be reasonably automated. And if you think about this, if you are now running operations with millions of transactions a day, human supervision is practically impossible, and human review is very difficult. So what are you going to do? You are going to create a whole set of agents to do that for you. And you started seeing little applications in management that are kind of supervisory or assurance-like type of applications. But this is like the virus problem. unless you have a profile of a virus. It's very different to detect the virus the first time. So you need to have time series examination and cross-sectional examination of the data that you have in order to identify things that were not identified by your detection devices. And there'll be things that will go through. But the purpose here is not to resolve every problem in the world. The purpose here is progressively do more assurance in a situation that human assurance would not be possible. Now, an interesting question is this really the auditor's job or is it a job of someone else? And we say that very often, is that if we don't do it, someone else will do it. Because this is obviously when you are going to have operations running millions of transactions a day, and faults cost you a lot of money, and I'm not even talking about fraud. Fault is a generic name for errors, anomalies, and some fraud in it. Then you have to kind of prevent that. It's kind of a trade-off of cost benefits. And remember what I said before. The economics here is that developing costs money, applying it doesn't cost money. But if you think about 2,000 apps running all the time in your audit system, that's already somewhat costly. So there has to be some kind of operating system controlling this. And we are trying a little experiment that maybe will test some of these ideas. And I just kind of wanted to conclude by reminding you first that Montgomery Auditing in 1919 talked about continuous auditing and then said, well, it's being abandoned, but we really should be doing a report every day. And to my joy today, I heard people talking about more continuous, even a prediction that continuous reporting will happen. If it will happen, it's not going to be without traditional balance sheet and LIFO, FIFO, these things. These are useless. They are going to be with other measurements that really help business. And remember, people used to run businesses with their financial data. Meaning when Pacioli was doing this was to run their businesses. Now you have big ERPs with thousands of reports, of which 5 or 6 of the reports are financial statements, but that's not what they use. That's the argument for non-financial data. And when people talk about non-financial data, people start thinking about big data. No. Your ERPs have huge amount of non-financial information that we don't use in the life cycle of the transaction to examine the transactions. And there where we start with not financial. Then, of course, there is the big data, non-financial, that you have a look. So I'm going to finish with this. I hope I gave you a little bit of food of thought here. I'm going to finish by reading this. A methodology that, the new CA definition, a methodology that enables auditor to provide assurance on the subject matter for which an entity's management is responsible using a continuous opinion schema issued virtually simultaneously with a short period of time or a short period of time after the occurrence of events underlying subject matter. The continuous audit may entail predictive modules and may supplement organizational controls. The continuous audit environment will be progressively automated with auditors taking progressively higher judgment decisions. The audit will be by analytic, by people, and by other means. It's cut out, so I had to kind of make it up. Okay, thank you very much. That was
Hi everyone. I was asked to read the recent Pink Book and react to it based on my background, which, as Nicholas mentioned, I work with.
This is the Pink Book.
The red book is in fact red. Yes, it's red cover. Yes, that's right. So I'm going to look at the Pink Book from the point of view of the external financial statement audit and how it will evolve. Okay, just a bit of background before I get into just 4 main topics of my discussion. Back in 1999, we were working on the Red Book, and now we've got in 2015, the Pink Book, and they're really very different environments. As Yogi Berra said, the future ain't what it used to be. And back in 1999, there was an environment where everybody was predicting that the end of the financial statement audit, the importance of, and the decline of the importance of historical financial statements. So in developing the Red Book, we were really thinking of continuous audits of other subject matters, internal control systems, more of the, somebody mentioned the AT 101 engagements in Canada, 5025 are now 3,000 engagements. And so the focus wasn't on a continuous financial statement audit, and we recognized, but the focus was on external audit, but we said that you can't do a continuous external audit without the help of internal audit. That focus has really switched in the Pink Book. You saw the definition that Miklos just put up. It didn't say external auditors, it's sort of an amalgam of internal and external. I think I'll establish there's less fear that the historical financial statement and audit is going to go away now. But it's really internal auditors that over that period of time have embraced continuous auditing based on the use of robust analytics. External auditors, they really haven't done it. I'll go over a couple of reasons why, but one of the main reasons is that if you look on the financial crisis and WorldCom and Enron, all of a sudden, at that point in time, remember I said in 1999 people thought the financial statement audit's gone. Perversely, those frauds, it rose like a phoenix and became really important. And all of a sudden, external auditors had a whole new set of revenue streams in terms of auditing under SOX, but they also had to face all these vast changes in accounting standards, vast changes in auditing standards, which I was involved with, a whole new regime of practice inspection, a whole new regime of independence rules. So they had to stick to their needing of the traditional service. They didn't have any time to focus on continuous auditing. And so that's one of the main reasons, I think, where there's been a lack of progress there, although there are others. Just I want to cover 4 views, and they're my personal views, over the next 10 minutes or so. I really want to focus on the last 2, but I have to establish the first 2. I'm going to maintain that there is the GAAP financial statements and the historical audit, and the audit of those statements is still going to be relevant and important going forward, but that is unlikely to become continuous in the near future. Eventually, yes, I would think so, but not, say, in the next 10 years. But external financial statement audits are going to definitely change. I think there will be an adoption of robust, highly automated analytics. And I think some of the presentations this morning led credence to that. And that with that adoption of the highly automated procedures, there's going to have to be some changes in auditing standards. So just a bit of background information then. In 1997, again, the historical financial statement audit and historical financial statements were under challenge. There was this paper by Sundam and Dukes, which I've read today, and it's still just as valid now as it was then. And they said that the traditional financial statements have continuing relevance because they really focus on contracting, and they provide a useful check on other more timely information that's available. And they maintain that you really shouldn't make them continuous because that would detract from their traditional, very useful purpose. On the other hand, what was generating a lot of thoughts about the decline of historical financial statements was they weren't really all that useful for a lot of decision making. And that comes up again. For example, one of the challenges we have in auditing standards and accounting standards recently is that regulators, particularly bank regulators around the world, were really upset that accounting standards and auditing standards weren't focusing on the ability of entities to continue as a going concern. And the EU, the banking community, they came up with this booklet on how to measure bank performance, and they made a point, for example, that return on you can get from the GAAP financial statements isn't really a good predictor of how a bank or other financial institution is going to survive a crisis. What you really want to focus on is something like RAROC, risk-adjusted return on capital, which you're not going to get from the historic financial statements. So that's saying for decision-making, historical financial statements, GAAP financial statements, I should say, are really not what you probably want to make continuous. But on the other hand, contrary argument is GAAP financial statements aren't what they were back in 1999. They've evolved continuously a lot. Huge changes in measurement basis away from historical cost into fair value and value in use, which are based on estimated future cash flows, taking into account present value and, quite frankly, big data. For example, changes in economics in regions and countries. And so that whole view of the financial statements being really restricted and limited has really gone by the boards. And that set out, if you read the draft IFRS conceptual framework, I don't think anybody can read that and not come away with a good sense of the real continued value of GAAP financial statements. And they are, though, based on estimates, judgments, more than exact figures, and that may be a bit of a drive back in trying to make them continuous. So my view is they're going to continue of real value, but they're not going to be continuous. There's just too much data there, too voluminous in the near term to manage on a continuous basis. They have moved up in the value chain, but they need to be supplemented with other performance measures that are communicated externally. Let's turn now to the external financial statement audit. Those of you in the auditing community would be very familiar with the AAA paper way back in 1973 about why are there audits, what is the value. I maintain that all these 4 parameters, the real drivers of audit, still apply today. And so I don't think that's changed. There's still the conflict of interest between entities and the public and users. There's significant consequences of using unreliable information. Everything's complex, and the remoteness still applies. Entities are not going to, even in this day and age, open up their information to anyone and everyone. So those 4 drivers still apply, so the audit's going to continue. Why not continuous? I already touched on that a bit, but really the AICPA white paper in 2012 mentioned this. It's just too costly to implement. The payback period would be very lengthy. There's now rotation required of external auditors, so why invest a lot in a continuous auditing methodology if you're going to be replaced? And businesses are still very protective of their data. They're not going to allow excess by a whole bunch of parties. And in the external auditor, there's going to be real resistance to making it continuously available, I would think. And there's no market. I learned it from trying to get one is involved with, trying to develop web trust, systrust with some of the people in the room. Unless there's a market pull, it's not going to work, and the entities aren't going to want to pay for a continuous audit anytime soon, in my view. Let's go on to then the more interesting part of the. I had to establish that first, but let's go on to the bit more interesting topic of the move to highly automated audits. And some of you may have read the study by Frey and Osborne at Oxford University that's often quoted. And they have gone through, did a very extensive study. They got 702 jobs listed at the back of their appendix. And they studied the likelihood of automation of jobs over the next 20 years. And they said there's a 94% chance that there's going to be job losses for accountants and auditors over the next 20 years, 2 decades. Telemarketers are at 99%. And recreational therapists, whatever that is, are at 0.0028%. So, but we're at the higher end of the scale. They grouped accountants and auditors because that's where all the data, the statistical data they use in the U.S., grouped accountants and auditors. And that's not bookkeepers and tax preparers. That's sophisticated auditors and accountants they're talking about. And why is that? It says the job is likely to be automated unless one or more of the following automation computerized bottlenecks apply. And that's the job. If a job involves perception and manipulation, it's less likely to be automated. We're not into that in accounting and auditing. Creative intelligence, social intelligence, people outside the profession would probably say we don't have any of that. But that's not true. I think we can argue that we do. And so the question is then, it's a 94% of job declines, but what jobs and how rapidly? And the question is how much automation. I read a really interesting paper by an engineer, and it's not just the accounting and auditing profession that's worried about this. It really goes across the board. And in this paper, the gentleman quoted a management consultant named Bennis, who his vision of the future was that in any factory or office there'd be 3 things. There'd be a really smart machine, there would be 1 person, and 1 dog. The person is there to feed the dog is there to bite the person if he or she tries to even touch that machine. So that's one of the visions. This engineer says, no, that's not going to happen. There's always going to be some human and automation involvement. It's not going to be entirely machines. But the question is, how is that interaction ever going to take place? Engineers deal with these audits, system performance optimization, and he threw out this equation. So you're trying to maximize system performance combining automation factors and human factors. And there also has to be the equation of trying to minimize the errors caused by the human factors. And so that's a very complex equation, but he said there has to be a lot of, obviously, research on that, so academics in the room can get involved in that. But it's interesting, though, he talks about judgment, flexibility, adaptability as being the human variables. But, of course, the Oxford study argued that, in fact, is going to be overtaken by machines over the longer term. And so one other thing I wanted to bring into play is that auditors are now under challenge from regulators about the lack of professional skepticism. And there was a really useful paper that was presented internationally at the International Board recently. It's by two American academics, Glover and Pratt. And they are talking about professional skepticism and people, and that's really known as the cause of audit failure. And they noted these four factors: human factors, overconfidence, confirmation, you're always looking to confirm things that management says as opposed to oppose them; anchoring, again, on what management has told you versus anchoring it on something you've come up with separately; and availability. You tend to use information that's readily available from your memory as opposed to information that's hard to get. And I would argue that proper implementation of robust analytics would address each and all of these. And so that's a strong argument why the audit should become more analytic. In the far distant future, and we're talking here about when there's really smart machines, based on, I agree with the premise that there's always going to have to be some human oversight of the machine, and management, internal auditors, external auditors, and those outside are going to be interacting with their own machine. But I just wanted to point out that still, if you still believe that the paradigm, the relationships between external audit, management, and internal audit will apply in the future, the external auditor has to be worried about how he or she is interacting with his own really smart machine, but you also have to be concerned about the interactions the management is having with its machine. There's going to be machine-to-machine dialogue and person-to-person dialogue and machine-to-person dialogue, and it's going to become immensely complex. I think the audit risk model is going to be evolved to focus on these interrelationships and the dangers of where things can go wrong with them. Let me then turn to the last part of my presentation. I just want to focus on the current, I'm talking about standards now and how they're handling analytics, analytical procedures. And as somebody noted earlier this morning, this standards have been around a long time. They're based on paper-based audits. They don't really recognize automation to any specific extent. And so that right now, you have inherent risk, control risk, and detection risk. You're all familiar with the audit risk model, at least the auditors. And so under the standards, we have the risk assessment analytical procedures. They use very imprecise data. They don't have to be, they're highly aggregated data. They don't have to be precise. Any inconsistencies will be investigated, but it's very high level, soft, airy-fairy. There's really no mention of use of analytics in testing of internal control specifically. Substantive analytical procedures, which you don't have to use, but if you use them, they have to have some rigor. But they're really not directly specifically connected with any of the risk assessment procedures, analytical procedures. There's vague connections, but nothing specific. And there you have to use disaggregated data, test reliability, material inconsistencies. But it's still mostly manuals based. That's sort of the philosophy behind it. And then we have where analytical procedures that's the only place they are required under the standards, is at the end of the audit, where you have to stand back and say, have I got the right conclusions? So you're looking at the forest as opposed to the trees. But again, they're manual, they're imprecise, high level. The data really is coming from the rest of the audit. And so you can see that it's very manual. There's no robust interconnections, in my view. How it will evolve in the future, I think, is along the following lines. Is that with robust analytics, you're going to have the auditor obtaining transactional data, big data from various data warehouses, the entity's warehouse, the auditor's own warehouse, other warehouses, and gathering all that relevant information, whether it's transactional or big data. And I would argue there's a lot of big data that's relevant even today. You can't ignore it. If it affects how the entity runs its business, it affects the audit. You can't get around that. It's in the standard. And so you have all this data. Then you have these automated procedures, and it could be, for example, three-way comparisons of data, segregation of duties test, 100% matching of customer data to the big data where it's relevant to your further procedures and cluster analyses. There's no segregation there between inherent risk, gathering information on inherent risk and control risk, or even between obtaining a risk assessment and substantive. It really becomes blurred, and that's not a problem. Probably the way it should be. And then you'll use that directly in determining your further automated procedures. So you will have done tests of reliability of data, for example, at that level, that will feed directly into your automated substantive procedures. Could be automated confirmations where you're going to be really rifle shot there based on outliers from your analysis. One of the big things is audit of accounting estimates, and that's one of my pet peeves. Everything I see, even in the Pink Book, it's all about transaction streams, and that's fine. You can't ignore that. The big problems come in estimations, and the financial statements are full of estimations that are huge, and they're based on different models, data from everywhere. That's where the big audit issues are, and that's where automated analytics can really help you out. And then at the end, I think, do you really need that stand back? At the end, I would argue yes. You need some kind of a smell test, automated smell test. What that might be, I leave that to people like Nicholas, but I think something like that's needed. That's my gut feel, and that's why you still need human involvement in the process. And last but not least, well, the implications are there's going to be a lot more multi-purpose procedures. You have a lot more 100% examination, so how can you justify that? Sampling when you can do that, which other people have raised this morning. It's going to be increased use of procedures that you're going to do all the time, regardless of risk assessment, because it will always make sense. And documentation is going to be a huge issue. How do you document these analytical procedures? And the last point I want to make is the Pink Book rightly focuses on internal audit and all the advances they have made using robust analytics. So then the question, and the standards then tells the external audit, yes, you should use the work of the internal audit function, but it's very restrictive. A lot of countries around the world do not believe in that. They don't believe that internal audit is not independent. You should not really be using their work, especially for direct assistance. But that's not our view in North America or in most other countries. You're going to be using their work, but how does that come into play when you have standards that are worded from the paper-based era, where you're talking about the external auditors to make all significant judgments and avoid undue use of the work of the internal audit function? Well, what's all these significant decisions when you get all these automated procedures? And you have to perform the work directly. What does that mean? You have to design your own analytic to duplicate what internal audit did? I mean, that makes no sense. And then sufficient procedures on the body of internal audit. Well, what do you have to do? Re-perform everything? I just don't know what those terms are in the standards today in terms of the use of the internal audit function, how they would apply going forward under the world of a lot more sophisticated analytics. So those are the points I wanted to make and my reactions to the Pink Book.
Any questions?
Greg, your presentation was interesting. Fascinating.
I
wanted to
don't
say.
like that word,
No, it
especially
was
from you.
interesting, but it made me think of two things, and I'm not sure exactly how it fits this panel, but I'll ask the question anyways. I was in Germany when the whole VW scandal broke. And of course, everything on TV was the BBC, CNN, every English-speaking news station that was either VW or the refugees. That's what all the stories were. And what was interesting about the VW story were all these professors and engineers and all these people who were coming out of the woodwork saying, oh, we knew this forever. And we knew this. We were running our own tests. We knew that these numbers made no sense that Volkswagen was reporting. But somehow the system breaks down because they report to a human. You know, they contact some human director of the German whatever, and they go, oh, you know, it must be your test equipment or something. And then that makes me think of Bernie Madoff, same thing. You know, that one guy was, I forgot the guy's name, but there was the one guy who kept saying his numbers just don't make any sense. They kept reporting this to the SEC, the New York securities people, and they kept discounting it. So it seems that the humans are the weakest link in those systems. So if we could replace everybody with robots, life would be good. We wouldn't have bad Volkswagens that are burning Madoffs anymore.
I'm not sure how to react to that, but my presentation was, it's obviously oversimplified. But the key is going to be in the design of the systems and the human involvement in that. But the idea is, and we're really highly criticized now for that very thing, is how can these things happen, especially the financial stuff like WorldCom, and not be detected by the external auditor. And the point has been made, and there is an obligation to look at material uncertainties, and people think, oh, they just arise all of a sudden. To your point, that didn't arise all of a sudden. That arose time over time. So the question is, how does an auditor, or internal auditor in this case as well, how do you tap into that? And that's where some of the so-called big data, if you can do those communications, there would have been communications around that. But there's also that old chestnut. Controls, even automated, are not going to work unless there's a good control environment. The philosophy, the soft stuff at the top. And that's what you're really, maybe in the future that can be automated. It's a culture of not wanting to impair the safety of the public just to make money. How are you going to automate that? I don't know.